Welcome back to Cryptonomics. Today we will cover the long-awaited Fed pivot, what the federal funds rate is expected to be in the future, how this impacts the markets and our portfolios, and a few new economic terms that will help us understand why the Fed policy is so complicated. Let's get started. So this week, Federal Reserve decided to leave their federal funds rate unchanged and signaled three cuts for next year. Previously, only one cut was expected for next year. The officials left the rate unchanged between 5.25 and 5%, where they have been there since July. After making the rapid series of increases that started in 22, that has pushed borrowing costs to the highest level in 22 years this summer. Officials held the policy steady for the last three straight meetings. This is because there is a lag in the data and they do not want to overshoot how much they're lowering inflation. This would mean that they would possibly crash the economy and a lot of people will lose their jobs. So they're treading carefully and trying to fine tune the interest rates and the unemployment to lower the demand to cool down the inflation. The Fed policymakers projected Wednesday that they would lower the borrowing cost to 4.6% by end of 2024. This implies three rate cuts. And how they projected this is what we covered last time. It's called the dot plot. This is the projections of the FOMC participants. These are anonymous estimates that they submit before the meeting. And this is for 2024. This is where we are now, about 525, 5.5. And the middle point here is about 4.6. This is where most participants are. You always have your outliers. This is what the market is reacting to, that the Fed might successfully land this plane without crashing it, also known as a soft landing, by increasing interest rates slowly and looking at the data. In this post, Chair Powell said that there's a little basis to think that the economy is currently in a recession. And if we're not in a recession, then there's really no need to lower interest rates right now. The Fed did not take the possibility of raising interest rates off the table. Fed policy is a complicated topic. So the reason it's complicated is the Fed doesn't know exactly, and they have a mandate to keep unemployment low and prices stable. And they're always juggling these two things. What's unique with this is we have not lived through a pandemic before where we have a supply shock and a demand shock at the same time. So the supply shock was the supply chains, and the demand shock is people were unemployed at home, maybe refurnishing their house, making an office. Also, people had extra money thanks to the 6+ trillion of fiscal stimulus from stimmy checks. So there was a higher demand, people wanting to buy things, and there was less stuff to buy at the same time. This was quite unique. Plus the pandemic situation of supply chains, things from mostly being manufactured in China. Usually when there's a high demand and prices go up, the supply will meet that demand because there's a lot of profit to be made. The fact that even when the prices go up, there's no stuff to buy, as we saw with toilet paper shortages during the pandemic, this was quite a unique situation. And that's because of the pandemic. The Fed isn't really clear on how to forecast what is happening. Now, there's a couple of economic terms I want to introduce you to. These are, you don't need to remember these, but this just explains why it is complex. One is NAIRU. NAIRU is non-accelerating inflation rate of unemployment. So there's a theoretical level at which unemployment rate of inflation is expected to rise. So if unemployment is low, a certain level, then anything lower than that level, that means there's no people out there, employees will demand higher pay. When you want to hire somebody, they will have many more options to choose from. They will start a bidding process between employers. This will create inflation. Also, if a lot of people have jobs, it means a lot of people have money, a lot of people can buy more stuff, and they're competing for the same amount of stuff. In economics, it is believed that there is a non-accelerating inflation rate of unemployment. So there's employment, it's called natural rate of unemployment also, where maybe it's 3 to 6%. This is totally guesswork. And at this point, there is no inflation. So that this is what we want. We want not 100% employment. So that's one concept. And the difficulty with the NAIRU is maybe the NAIRU rate has changed post-pandemic. There's a lot of work from home, a lot of changes in the economy, technology. So maybe this theoretical number might have changed. So that's one difficulty that the Fed is dealing with. The other thing I want to introduce you to, it's called the Phillips curve. Phillips curve is an economic theory that states that inflation and unemployment are stable at an inverse relationship, meaning that once unemployment is low, inflation is high. So if you can see here, this is unemployment and this is inflation. So if unemployment is low, closer to the y-axis, this is 0. So if unemployment is low, then inflation is really high. If you increase unemployment, let's say 4%, then the inflation comes down. What we have learned in modern economics is this curve is very dependent on the perceived interest rate or inflations about the future. So whatever the people believe will happen in the economy is actually more important than the reality. So perceptions are more important. This is why the Federal Reserve communicates and tries to get the markets to believe a certain thing before it's actually true in reality. So perception, this is called the Phillips augmented curve. The augmentation is expectations. So through communications, the Fed influences the expectations of the market. Right now, the expectations are that the interest rates will be lowered 3 times. That is actually more effective than the Fed lowering the interest rates because they signal they will do that. The market reacts immediately as if it was done already. Stocks went up, crypto went up, all the markets reacted as if interest rates will be lower because the markets are forward thinking. The markets know that next year interest rates will come down. So we shouldn't wait for the interest rates to come down. We can allocate our portfolios accordingly as if they already had and front run the market. So that's what just happened with the US stock market after the Fed announced that they will be holding rates steady and possibly reducing the federal funds rate by 3/4 of a percentage point based on the dot plot projections. Okay, now there is a third component of why this is very important and how it will impact your portfolio. Federal funds rate that the FOMC sets impacts the short-term and long-term rates on bonds and other financial instruments when it comes to lending. As of December 6, 2023, we have about $6 trillion in money market funds. Why this number is very important. 6 trillion is a lot of money. So this money is sitting earning the 5.25%, 5.5% in money market funds. If you want to learn how you can make this 5%, check the video of how you can earn 5% in your Fidelity money market account or with Coinbase using the USDC coin. As many people are earning their 5%, like I have shown you how to do in the previous video, when the interest rates come down, all those people will be making less money on their cash sitting in the account. The term opportunity cost refers to what is the cost of you doing one thing when you could be doing another thing. In this case, the opportunity cost is 5% in the money market account, or you can put your money into something else like real estate, stocks, crypto, or another asset. Money market is a next to risk-free instrument, and you get it for doing literally nothing. When the interest rates come down, then you have to consider, is there a better opportunity? What's the opportunity cost of keeping your money in a money market account when you're earning 4.5% instead of 5, let's say? So other alternatives become more attractive, let's say, even in a risk adjusted way. So what is expected to happen for every 1% of interest rate cuts? Out of that $6 trillion sitting in money market funds, there will be some outflows. At a certain level, let's say 4%, some people that are willing to take their money and put it into, let's say, stocks or crypto to try to earn a higher return because they need a higher return of 5%, let's say 5 to 7, to maintain their investments the way they want. So they will take on more risk. Last estimate I saw on this was for every 1% cut, $1 trillion will leave from the money market fund. If we get almost a percentage cut next year, then we can expect $1 trillion of those dollars to go into other assets, stocks, crypto, real estate. So this is why this is really important. Now things can change. As I mentioned, this is a complicated topic, and the Fed doesn't have all the answers. They're doing the best they can with the data they have. Their best guess is that they will be able to cut or need to cut 3/4 of a percentage point next year because the economy will need that. Maintaining interest rates this high, it could be damaging to the economy, cause a recession. So they don't want to overshoot and have too many people lose their jobs and inflation to go below 2%. Now, there's another very important thing is higher the interest rates are, more it costs the government to finance its debts. At certain level, at certain point, the debt of the government is so large and the interest obligation is so big that it becomes unsustainable. Arguably, we might already be there, but hopefully the government has figured out a way to lower their interest obligations and stimulate the economy where the growth of the economy makes up for the extra interest we have to pay on the extra added debt. And if the economy grows faster than expected and the government brings in more revenue, then it can service its debt. I would argue that this is unsustainable at the current levels of how much just interest we're paying on the debt, that the principal will never be paid down. And many governments around the world have gotten into this debt spiral where they can barely just make the payments on the interest and just skip printing money. Which brings us to why we invest in crypto as a protection against the inflation and governments printing money ad infinitum. There is no limit to how much money, US dollars, the government can print. There is a limit to how much crypto will be created or other scarce assets. How many shares of good companies there are, how many desirable houses there are in the world, how many plots of land where you can farm on. There are scarce assets that will appreciate relative to money being printed. Money printing is not going to stop. It is built into the system. Inflation is not going to stop. It is built into the system. So you have to invest to protect yourself. Some of the best ways to invest are index funds, real estate, and crypto. On this channel, we will focus mostly on crypto and various tech stocks that have high levels of growth. Stay tuned, subscribe and follow to learn how to protect yourself from the infinite money printer that goes brrr.